Good evening and welcome to Corporate Connect. I'm Lucas Ng from SIAS, your host for today's event. Tonight, we are delighted to have CapitaLand India Trust with us, as well as our audience joining us on Facebook Live. This webinar is brought to you by SIAS and supported by SGX Group. Our agenda for today's webinar includes a presentation by Mr. Jeff Howie, Market Strategist for SGX Group. He will discuss recent market highlights. Following that, we will have a corporate presentation by Mr. Sanjeev Dasgupta, CEO and Executive, Non-Independent Director of CapitaLand India Trust. Finally, we will conclude with a Q&A session. So CapitaLand India Trust was listed on SGX in August 2007. It's the first Indian property trust in Asia, structured as a business trust. They offer stable income distributions similar to a real estate investment trust and focus on enhancing shareholder value through active property management, development, and strategic acquisitions. They are also capitalizing on India's fast-growing IT industry and logistics, industrial asset classes, with a proactive approach to diversify into new economic asset classes like data centers. As of June 30th, 2023, their assets under management stand at $2.7 billion. Their portfolio includes 9 world-class IT business parks, 1 logistic park, 1 industrial facility, and 4 data center developments across major Indian cities. So without further delay, let's turn the floor over to Jeff to provide us with insights on market performance. Jeff, over to you.
Thanks so much, Lucas. I'll just take a quick 10 minutes just to run through, as Lucas mentioned, some which screen am I actually sharing? Hang on a minute. Yeah, screen 2. Thank you. Okay, apologies for that. So what I just wanted to mention is that we had a pretty turbulent month of August in our stock market. The Singapore STI ended August at in the 3230s. So that's a 4% decline in price, but dividends reduced that decline to a decline of 2.5%. We effectively had 100 stocks that went ex-dividend in the month of August, which included a number of STI stocks. So it brings the STI's total return over the first 8 months of the year to 3.8%. What was interesting, very interesting, was Singapore stocks booked net institutional inflows of 400 million and net retail inflows of 600 million as well. So that's both inflows, both segments booking net inflows. Has been an uncommon occurrence in recent years. And those combined net inflows reverse the combined 1 billion thereabouts of net outflows of both of those segments, institutional and retail segments, in both June and July. So interesting as well, for the month of August, the IAG S-REIT index decline in August pretty much mirrored what we saw in the STI. The IAG S-REIT index was down 4.2% in price and also down 2.5% in total return. Longer term, the S-REIT sector, it has grown at a compound annual growth rate of 7% over the past 10 years. And the FTSE ST REIT index maintained a 10-year total return of around 70% as of the end of July. REITs still account for close to 20 cents in every dollar that goes to work in the Singapore stock market every day, and they still represent around 10% of the total market value of all stocks listed on Singapore Exchange. The FTSE EPRA NAREIT Developed Index, which is designed to track the performance of listed real estate companies and REITs all across the globe. It has 370 constituents, of which 300 represent the REIT sector. Placement in the index is highly coveted by global REITs due to the span, I guess, of passive institutional investors that track the index. And on Monday, Digital Core REIT, which is a pure play data center REIT listed here in Singapore, sponsored by Digital Realty, announced it will be included in the FTSE EPRA NAREIT Global Developed Index with effect of the 15th of September, while Manulife US REIT has been omitted from the index. So from the end of 2019 to the close of trade yesterday, the FTSE EPRA NAREIT Developed Index, it has declined 21% in price in SGD terms, and reinvested dividend distributions reduced the decline in total return to 9% in SGD terms. The same time, You have the IEdge S-REIT index, which is comprised of much less, 35 constituents. From the end of 2019 through to the close yesterday, declined 24% in price, but reinvested dividend distributions reduced the decline in total return to 7% in Singapore dollar terms. So very similar. One, the global benchmark down 21% in price, IEdge down 24% in price, but IEdge a lesser decline in total return because the IEdge S-REIT index maintains a yield around close to 6% versus FTSE EPRA Nareit Developed Global, which is more in the vicinity of 4%. That while those total returns as well of the local and the global benchmark, they're comparable over the past 3.5 years with some directional correlation. You don't see as much week-to-week correlation as you would expect, though, and that's obviously due to different geographies. As much as 60% of the FTSE EPRA Nareit Developed Index represents US properties, whereas most of the AUM in the S-REIT sector is in Singapore, followed by the Asia Pacific. And REITs are very diversified by where in the world they invest here in Singapore. In Singapore, as many as 17 of the trusts exclusively invest in properties outside of Singapore, with 20 of the trusts investing in properties in both Singapore and outside Singapore, and the remaining 3 REITs investing purely within Singapore. It includes as many as 14 trusts with properties in Australia, 11 trusts with properties in China, 11 trusts with properties in Japan, and 9 trusts with properties in the US. And CapitaLand India Trust is a business trust, and all its properties are located in India across 5 top-tier cities. And there is just one other trust in our S-REIT sector that has a small exposure to India, and that is Maple Tree Logistics Trust with an industrial park in Pune. So as reported last week, if our focus is on India, we had our real GDP for the first quarter of the fiscal India year released last week, and that June quarter saw real GDP accelerate to 7.8% growth year on year, and that was up from 6.1% in the previous March quarter. Private spending and investment remained the 2 key growth drivers, and that accounted for around 90% of that 7.8% June growth. And it was very much helped by infrastructure project spend, which is also associated with the FY23, FY24 budget. And this was this 7.8% growth was for the first quarter of the FY23-24. Business investment also gained something like 8% year on year, and that followed 8.9% growth year on year in the previous March quarter. So interesting too that the export contractions, which really began in Singapore, Taiwan, and South Korea in the latter half of 2022, we saw the export contractions begin in Singapore, Taiwan, and South Korea. For Singapore, it was in October. That's also caught up with India. We've seen it catch up with Malaysia, and it's now caught up with India with exports of goods in contraction after 9 straight quarterly expansion quarters for exports. So that was its first year-on-year decline in the June quarter in 9 quarters. And that's obviously the external environment that much of the world is looking at. 2 key risks, having those tighter financial conditions and decelerating growth, has been a common overarching theme that's really reaching much of the world now. But nonetheless, that June quarter, as we said, it represented the first quarter of India's FY23-24. UOB estimate that India will book 6.5% growth for this fiscal year. The IMF back in July also attributed the stronger domestic investment to an upward revision for their estimate for FY23-24, and that's now projected to grow at 6.1% and even higher at 6.3% in the following FY growth. So I just wanted to give a little bit of sort of macroeconomic color there on India, given the focus obviously of tonight's presentation. For CapitaLand Investment Trust, if I remember right, its NPI has also been growing, much like the India economy. I think the NPI grew 3% year on year in the first half of this year, and that's following 7% year on year growth in 2022 for their NPI. But for our REIT sector as overall, the S-REIT sector, is well diversified also by the type of properties in portfolios. So diversified S-REITs now make up the largest subsegment of the sector. I think we have 9 diversified trusts in the S-REIT sector now, making up 40% of the day-to-day S-REIT turnover. And as CapitaLand Ascendas REIT very neatly articulates, all in all, geographical mix and multi-asset portfolios do allow REIT managers to diversify risks across industries, customers, and currencies. So the 40 REITs in the property trust of the S-REIT sector also ended July with an average gearing ratio close to 38%. That is below the regulatory limit of 50% if the minimum interest coverage ratio is at least 2.5 times. And although CapitaLand India Trust is a business trust, it has voluntarily adopted a number of S-REIT restrictions in their mandate, and that includes that 50% gearing limit, with CapitaLand India Trust maintaining a 40% gearing limit as of the 30th of June. The average yield for most trusts of the S-REIT sector was in the vicinity of 7% as of the end of July. CapitaLand India Trust maintains a yield on our stock screener of 6.5%. It ended the session today at $1.18 a unit. That's up from $1.07 at those 21st August lows that we saw, with the overall broad market weakness forming its August lows on the 21st of August, and up from $1.14 at the end of the 31st of July. So the Refinitiv consensus estimate target price for CapitaLand India Trust at the moment in our stock screener is at around $1.33, $1.34, and those Refinitiv consensus estimates represent the average of individual estimates that's provided by analysts that obviously cover the stock, and estimates typically represent the opinion of stock performance over the next 18 months or so. So just to make that clear, that disclaimer. But just to end off, much of the 20 plus years of the success of the S-REIT sector has been attributed to their comparatively high distribution yields and the institutional and the retail investor appetite for dividends. As we said, in August, we had retail inflows and institutional inflows. The sector that saw the most retail inflows in August was, of course, the REIT sector. And since the end of 2021, the S-REIT sector has booked something like 2 billion Sing dollars in net retail inflow. So I will stop the share now, stop the sharing, and really looking forward to hearing more from Sanjeev and the team at CLINT, or CapitaLand India Trust. Thank you.
Thank you, Jeff, for providing us with the insight. Next, I'd like to invite Sanjeev to share their latest business updates with us. Sanjeev, over to you.
Thanks. Thanks, Jeff, for giving a good brief overview of the Indian economic situation, especially the first few months this year. I think India has truly been an outlier on growth for a variety of reasons. It's been a combination of geopolitics, strong domestic consumption, and services exports. Some of those, or most of those trends, also directly affect our business and the growth that we can deliver to our investors. So I have a short presentation here, which will probably take me about 15 to 20 minutes. And thereafter, we can dive into questions. So this is an overview of CapitaLand India Trust. We are present in the top 5 cities in India, which represent probably more than 50% of India's consumption. We have 19.2 million square feet of completed floor area, which is income producing, 15 assets. About 91% of our assets are green certified, 2.7 billion AUM, market cap 1.4 billion and growing. In addition, one of the things which is quite unique to us is we have substantial floor area which is available for development, and that's been a big driver of our profitability over the years. The mix of assets, so we are in all the 3 asset classes which have been growing because of the fundamentals. We have business parks that are focused on the technology sector. We have 4 data center developments in India in all the 4 key markets. And then we have 2 industrial and logistics facilities. Happy to say that The second manufacturing facility for iPhones that was set up in India is a part of our portfolio. It's a factory leased to one of the large Taiwanese contract manufacturers in Chennai. Moving on, if you look at our portfolio, therefore, by valuation, we have about 88% of the portfolio focused on biz parks for the tech sector, 4% data centers, 8% industrial and logistics. In terms of the geographical split, our two largest markets are Bangalore and Hyderabad, followed by Chennai, Pune, and Mumbai. Our historical presence has been in the southern part of India, which is why you see Bangalore, Hyderabad, and Chennai almost sitting at 73% of the portfolio. And our foray into the western part of India is more recent, which is in Pune and Mumbai, started about 7 years ago. So some of the key milestones over the last 2 years, which have aided our growth and expansion, it was, I must say that after this, the first couple of waves of COVID, we saw some very good opportunities emerging in India, and we really, we were quite swift to move forward on those transactions. So we bought a logistics facility of about 400,000 square feet in Panvel, close to the Mumbai port. In March 2022, then we acquired the iPhone manufacturing facility in Mahindra World City. We also announced the acquisition of the second phase of that facility. And I'm happy to say actually that the same company has now decided to lease the second phase as well, though we started it as speculative. So it's again a validation of the growth of the electronics manufacturing sector in India, which continues to play out favorably to our advantage. We also signed a non-binding term sheet, and I think we should be finalizing this, signing the binding documents over the fourth quarter of this calendar year with a company called L&T, which would give us access to almost $1.4 billion worth of IT park assets over the next 4 to 5 years. We also signed a MOU to build a data center in Hyderabad that's currently under construction. We also acquired a new site in December last year for a new data center in Chennai. And we just finished in Jan this year a 1.4 million square feet new building in Hyderabad. And the last acquisition, which was of a large IT tech park from the sponsor in May. One of the key pillars of our growth at CLINT is sustainability, ESG, I should say. We have a substantial part of our portfolio now powered by renewable energy. Sorry, I mentioned 90%, but it's about 87% of the buildings or the assets are green certified in the business park portfolio. Almost half of the loans are sustainability linked. So we have undertaken covenants around sustainability for our lenders. And we are building a solar plant in Tamil Nadu, which will supply green power, solar power to our business parks in Chennai. The first phase of this should be going operational very soon, which is 21 megawatts, and then we have the next phase a few months later. We are actively engaged in our community. We contribute meaningfully to school building, to skill development. We focus on training. We have built 2 schools recently in India, in Bangalore. I'm also very happy to say that we just got the 4th rank in the recent Singapore Governance and Transparency Index rankings. So we moved up from the 6th rank to the 4th rank. And we have done favorably in our first GRESB Grade A public disclosure report. Just a few highlights of the equity raise that we did in July. It concluded. So this was to fund a few different projects. It was to pay the last part of the capex of Block A, the new building in our IT park in V, which is redevelopment. So just to give you a little more color about this, I will come to it on a subsequent slide. So that was one of the reasons for this raise. The other factors for the raise were the forward purchase transactions. We have two well-positioned, well-located forward purchase deals, one in Bangalore, Garden City, and the other one in Hyderabad, A1. So a part of the proceeds were getting used for that. This deal or this financing for these acquisitions and this development will deliver a 4% DPU growth. So we raised $150 million. It was oversubscribed in a tough equity raising market. We got 112% subscriptions. We priced the issue at about 106, which is a 6% discount to the adjusted VWAP. We have brought down our gearing post the pref to 36% now. I want to mention that we also have a fair amount of cash on our balance sheets, which we redeploy for growth. So if we actually look at our net gearing, it's 33%, which is quite comfortable. And we now have quite almost just short of $1 billion of debt headroom. Some of the key highlights of our first half financial results: the equity raise brings down gearing. Our AUM stands at $2.7 billion. Net property income is $85.6 million, increasing by 3% year on year, as Jeff mentioned. If we look at our INR NPI growth, that's closer to about 8%. Our committed occupancy, I'm very happy with this because our committed occupancy in 2021 had dropped to about 87%. I'm really happy that we've been able to bring it back up to 94%. We have now completed floor area of 19.2 million. So during this year, we have added 3.7 million square feet already in terms of our floor area in the first half, so which is quite a substantial growth. So this is a very good example of how CapitaLand India Trust has been delivering value to its unit holders. So the V Park in Hyderabad used to be about a 1.4 million square feet development, and 1.3 million actually, and now but because of certain changes in the plot ratio regulations, we can redevelop this park into a 4.9 million square feet development without incurring incremental land cost. And land in this micro market is worth almost about close to $13 million per acre. So we are saving a substantial amount of land acquisition cost through this redevelopment. So where today Block A sits, we had earlier a 200,000 square feet building, which we tore down about 3.5, 4 years ago. And we now have replaced a 200,000 square feet building with a 1.4 million square feet building. Just this development alone increases the valuation of this asset by 14%. So as we complete over the next 7-8 years, the rest of the redevelopment, it's going to be highly NAV accretive and DPU accretive to our unit holders. I'm also very pleased to tell you that we've actually we received our occupancy certificate for this building in January this year, and by June we were fully committed, inclusive of options, rights of first refusal, and the income recognition is the forecast income recognition is what you see on the chart out here. We are currently at about 33% income recognition as of June, going up to 55% by September, and by end of the year 90%, and then by next year we get to about 95%. The other fact that we are very happy about with this project is we've brought in some very, very high quality multinational tenants into our portfolio for the first time. Of course, we already have a fantastic multinational Fortune 500 roster in our tenant base, but we added names like EY, Warner Brothers, London Stock Exchange, Bristol Myers Squibb. So very, very high quality new names that were added into this building. Moving on to the next slide. If we look at our first half results, we grew our total revenue by about 18%, and our in rupees and Sing dollar terms, it grew by about 7%. NPI growth of 12% and 3%. DPU declined primarily for two reasons. One is, of course, we have a much larger base. Our base went up by about 12% in terms of new units. And because we did a preferential offering, it is, we have to distribute the income for all unit holders equally, barring the sponsor. So, and the other point is, of course, there was also about a 10.4% currency depreciation. So if we had not had the currency depreciation and the increase in number of units, then we would have probably been about a 2 to 3% DPU, so close to year-on-year flattish kind of a DPU profile. These slides are helpful to understand the historical growth trend of CLINT. Over the last 6 years, we've grown our revenues by 8% in INR and about 3% in Sing dollars. If we go to the next slide and look at our NPI profile, we've grown 11% in INR and 6% in Sing dollars. Also, the other thing, of course, which often is on the mind of many existing and potential investors is currency. So sure, the currency has depreciated significantly from the time of listing, almost 56%. But however, we've still been able to grow our DPU by about 33%. And how did we achieve this? It's basically by growing our earnings much faster than the currency depreciation. So we typically in our business plans, forecast about a 4% sort of a currency depreciation. And most of the years, if you look at it over a 7-8 year time frame, we've grown our NPI by about 7 to 8%. So actually almost like 9 to 10%, which is why if you look at it in Sing dollar terms, we've been able to outpace currency depreciation by a significant margin. Capital management, conservative. Currency hedging, as per the board approved policy, we hedge at least 50% of the balance sheet. Typically, our hedging has ranged between 50 to 75%. Income repatriation is semi-annual. Funding, again, is quite conservative, which was reflected in our recent equity raise. And that's the reason why also investors have expressed a vote of confidence in our ability to manage our balance sheet. If you look at it, the investors who came into the preferential offering at 106 are already sitting in the last 2 months at a total return of close to about 14-15%. And that's how we continue to earn the trust of our investors. If you look at the debt maturity profile and the balance sheet capital structure, 73% of the debt is fixed rate. Hedging ratio sits at 60-40. Gross gearing 36%, net gearing 33%. Interest service coverage about 2.7x. The weighted average cost of debt is about 6.3%. And about 99% of the borrowings are unsecured. Coming now to the markets where we operate, I mean, definitely COVID has had two key aspects to the impact of COVID. One was, of course, work from home. Now, I'm happy to say that this year we have seen a significant change in that. Almost about 60-70% of the employees are back in the office now. That did have some impact on occupancy. The other thing which also impacted occupancy was the fact that a lot of tenants chose to relocate from grade B office to better locations, and therefore we saw churn in the the kind of assets that tenants chose to operate out of. In terms of the number of tenants we have in India, about 295. The largest tenant is about 12% of the portfolio base rent, and committed occupancy sits at about 94%, including Block A options and ROFRs. And if we exclude Block A options and ROFRs, we are at 91%. The lease profile, about weighted average lease term, sits at 6.5 years, 3.5 years of WALE. Also pleased to mention that most of the leases that are expiring in this year have already been renewed or very likely to be renewed. So we don't foresee a major churn. In fact, if I'm not wrong, our tenant retention in the first half of this year stands at about 83%. Rental reversion. So this chart is sort of more reflecting rental reversion in line with how the other S-REITs calculated in Singapore. But I think I would rather move to the next slide, which is a better representation of how much rental upside is there within our portfolio. So if we look at Bangalore and Hyderabad in particular, we've seen so what this chart is giving us is the difference of the average headline rent of those rents which have been signed, those leases that have been signed in the last 12 months versus the average rent of the property. So essentially the portfolio rent is a lot lower than the rents that we are currently signing. So that is a better reflection of the upside potential on rental reversion. And so in Hyderabad, Bangalore in particular, we do see good rental reversion scope. Hyderabad, our properties are extremely well located. We also in Bangalore have a new metro station that has just opened up just outside the gate of the park, which we think will significantly aid to leasing momentum in that park and our ability to drive up rents. This is an interesting case study we've included here, ITPC. So this is a reflection of what happened through COVID. Pre-COVID in this asset, we were at a headline occupancy level of 99%. And that dropped all the way down to 66% in the first quarter of 2022. And I'm pleased to say that we are actually, by end of June, we were back to 93%. And in fact, if you look at the most current figures, I believe it's about 95, 96%. So essentially, we had quite a few large leases that were coming up for expiry, and we had a pretty robust leasing pipeline for those vacancies. However, come COVID, a lot of the tenants who were expected to sign up chose to actually defer their new take-ups. So we had to go out looking for new tenants. And of course, we also were fortunate that one of our big tenants chose to expand. So that's what brought us back to such high levels. So Deloitte was a new tenant who signed up substantial space with us. And then we also had Bank of America, Merrill Lynch expanding their space significantly, which brought us back to a high level. So these are just the names of some of our tenants. Most of them are Fortune 500 companies. Pegatron is the iPhone manufacturing company. And then Arshia is a master tenant of our warehousing facility in Mumbai. Diversified tenant base representing across many industries. So it helps us through the cycles of through ups and downs of economic cycles, to have a diversified industry exposure. If we come to our growth track record, we've grown in terms of area at a CAGR of about 11% since IPO. Total of this, about 7 million came through development and about 9 million came from acquisitions. So our growth strategy, 4 key elements: the development pipeline in Bangalore and Hyderabad, and also in Chennai. Third-party acquisitions, we have several forward purchases in the portfolio, which will add significant area over the next few years. On the non-park, which is logistics, industrial, and data centers, We've got a large industrial park on the outskirts of Delhi. We have the phase 2 of Casa Grande industrial facility in Chennai. And then we have 4 data centers aggregating to almost about 140 megawatts of capacity. And we have some sponsor assets in private equity funds, which are all, both in business parks and logistics, which are also potential growth avenues. So as I near the end of my presentation, we are at 55% growth projection based on the committed pipeline, which is a mix of third-party acquisitions, the developments underway, and the non-IT park assets. This is just comparison of how we've done versus various stock other indices relevant for real estate and REITs. Moving on. Yeah, I think that brings us to the end of the presentation. By the way, one slide which I did not see here, but I think I'll just mention is for the forward purchase pipeline that we have, our funding requirement is roughly about, used to be about 800 million, and now with the pref offering, it's about 650 million.
Thank you, Sanjeev, for the insightful presentation. We'll now transition to the Q&A session. Please feel free to submit your questions in the chat. For our Facebook audience, you can click on the link provided to join us in Zoom and ask your questions. We'll do our best to address as many as possible. Now I'd like to welcome Mr. Sunny So, Lead Technical Analyst, Capital Markets and Investor Education at SIAS, to moderate the Q&A session. Sunny, over to you.
Thank you, Lucas. Thank you, Mr. Sanjeev, for the detailed sharing of the first half performance of CapitaLand Investment Trust. So we hear that there is a very steady operational performance in the first half of this year. However, the DPU was partly affected due to the currency exchange or the strength of the Sing dollar. So going forward, what are there any measures that CapitaLand India Trust is going to do to manage the strength of Sing dollar and the INR?
So we have a fairly steady approach to currency hedging, as we are currently in about 60% of our portfolio is hedged to INR, the loan portfolio, and opportunistically we will keep increasing this number. The last year was a year of particularly sharp currency depreciation, but that's not typical. If you look at the long-term trend of currency depreciation, it's more about 3 to 4%. In fact, this month already compared to last year, the currency has actually improved in favor of INR by about 6-7%. So therefore, I actually think the second half of this year, we'll get some benefit of that flowing through the earnings. And of course, as I said, we will continue to hedge appropriately.
Okay, thanks for that. So I'll move on to the next question, which is about the DPU that was recently seems to be declining, partly due to the FX issue. What are the other actions that CapitaLand India Trust would be taking will they be looking at maintaining the DPU at current level, or looking at going forward, maybe if the operations environment allow, the DPU could actually increase in the next few quarters or next few years?
So I think the biggest reason for the decline in DPU outside of the currency, the biggest reason really is the cost of financing that has gone up significantly. I mean, if I just look at it over the last, I'd say for the last 3 years, our cost of financing used to be about 5.1, 5.2%, which is now almost at 6.5%. This is, of course, including the cost of hedging. So therefore, the preferential offering that we just did was a very, very important step. And with that preferential offering, actually, and our gearing coming down and it providing us headroom for growth, I feel much more comforted about our interest cost reduction. So I think the interest cost reduction from the pref offering will kick in the last 5 months of this year. And then the effect of that will continue in the next year, which I hope will be beneficial for our DPU.
Okay, thank you. So on that gearing questions, one of the online questions that we received was Mr. Raymond Ang, who pointed out that financing cost at 6.3, or what you mentioned just now at 6.5%. Even at this level, it is still slightly high compared to the market rate. So will there be any more actions that CapitaLand India Trust will take going forward, or will there be any more fundraising activities in the next 12 months?
So what we have done proactively is we have fixed, we have more than between about 70 to 80% of our loans are now fixed rate loans. We are also opportunistically using revolving credit facilities, RCFs, for our short-term financing needs. So I think these are some of the things which I think will help us, because we do believe that over the next 12 to 24 months, we are going to see interest rates stabilize and maybe even gradually start coming down. One important fact which I want to highlight, though, is compared to many other developed markets, the property yields in India are a lot higher. So there is more buffer between the finance cost. So, I mean, if I have to put that in numerical terms, if in Singapore I'm buying an office building, let's say at 4.5%, and I'm borrowing at, maybe whatever 4% today, I mean, that margin is extremely thin. Relative to that, in India, I'm buying properties or developing properties at almost like a 9 to 10% kind of a yield. And so therefore, even at a 6.5% financing cost, I'm still able to get accretion.
Okay. So rounding up these questions on the gearing, the debt ratio, as well as the strength of the FX or the management of the FX, do we see the DPU, or should unit holders be expecting that the DPU will be increasing, or will be likely be still be around the current levels from the projections of CapitaLand India Trust?
See, I can't give you an outlook for the DPU. We have refrained from doing that. But what I can say is, let's just look at what were the three main reasons for the DPU getting impacted in the first half of this year, right? They were currency depreciation, financing costs, and issue of new units. So if you look at the next 12 months, or let's say the second half of this year and next 12 months, the financing cost will come down to some extent because of the preferential offering. The currency is actually, outlook seems to be improving right now.
Yes.
And we are not going to do another equity offering anytime soon. So all of those three factors should be beneficial from a DPU standpoint.
Okay, I believe that will address some of our concerns that the unit holders are having. So looking at the business, so is CapitaLand India Trust looking at, given the occupancy rate, that there is still some gap to full occupancy, is CapitaLand India Trust looking at diverting or looking into data centers to expand further?
Yeah, so we currently have 4 data centers under development, which is accumulated, which are total capex of about 1.4 billion Sing on a DC operator basis. So, and plus we are also growing our logistics and industrial asset base. So we definitely will see more diversification in our portfolio over the next few years. However, I do want to point out that actually, though work from home did have an impact on the office market in India, just like it did in many other markets, but the nature of the activity that tenants carry out in India is, software development, R&D, these kind of activities. And they have been, especially many of the companies now this year, have pushed their employees very, very hard to come back to the office. So now actually and also just to give you a basis for comparison, even before COVID, the physical occupancy used to be about 80 to 85%. It was never 100. And now we see that figure coming to about 60 to 70%. So we are almost about 75 to 80% back to pre-COVID levels. And many companies, like especially if I look at the US banks, if I look at some of the IT services companies in India, they are now very, very pushy, or rather they're putting a lot of pressure on their employees to come back to the office, and they're not at least 3 to 4 days a week they want the employees back.
I see. Okay. Yes, we hear that. So regarding this work from home kind of a global kind of phenomenon that's happening, we also see that recently in the US, WeWork, the co-working company, the co-working space company, actually went down. So is in the tenant mix of CapitaLand India Trust, are there any significant numbers of co-sharing workspace in the tenant list or the tenant makeup of the portfolio?
So we've always been quite conservative in our leasing strategy. We were always concerned about the potential impact of co-working companies' poor creditworthiness on the portfolio. So we actually never leased space to any co-working companies. Instead, but co-working at the same time, I must say, is emerging as an important part of the leasing mix today, even in India. So what we have done is that we have built our own, or we have taken our own co-working brand called Bridge Plus and expanded that into India. So we now have Bridge Plus in Bangalore. We are just finishing 2 new Bridge Plus facilities in Hyderabad and Chennai. So that approach has actually helped us because there's good demand for co-working, but on the other hand, because the facilities belong to us, we don't have any credit risk. So that's how we are playing in the co-working market space.
Okay, we will take one question from the live Q&A that we are having right now. And that question is, are we able to increase the rental to compensate for the FX risk of the weakening of the INR and the higher interest rate factor? Do CapitaLand India Trust has the ability or the bandwidth to increase rental rates in the next 6 or 12 months?
So our rentals, our lease agreements have a built-in escalation clause whereby we get an effective rent increase of about 4.5% to 5% every year anyway. If you look at one of the charts I had there which showed the rental reversion potential of the portfolio, and if you look at the kind of rental growth we've had over the last about 7-8 years, it's been close to about 7 to 8% per annum. So even if we put a 3-4% decline in currency against that backdrop, Sing dollar terms, we're getting a 3 to 4% growth every year over the last 7-8 years. So I do think that we have been able to get a meaningful rental escalation in all our contracts in excess of inflation and currency.
Okay. Okay, we'll take on another question from the live audience that we are seeing. CLINT has actually signed an agreement with a local developer for a large pipeline of office development. We do not see data centers going to be forming a larger or maybe a more significant part of India's trust. So could Mr. Sanjeev provide more colors on this strategy of focusing on the office development part of things in India?
Can I request you to repeat the first part of the question? I got the second half of the question. I couldn't get the first sentence.
Okay, sure. So the first half of the question is CapitaLand India Trust signed an agreement with a local developer for a large pipeline of office development. So compared with the recent development that we see a lot of data centers coming up in the property sector. So can you share more colors on this strategy that on focusing on office assets instead of focusing on data centers assets?
No, so let me firstly clarify is that we are growing both these asset classes. We are growing data centers. We are also growing office. Uh, India's office market is quite unique. It is mainly catering to IT services companies, companies that are offshoring their technology development function to India. India is the second largest technology outsourcing country in the world after the United States. So it's clearly a market leader. So we continue to see healthy growth in the business park segment focused on IT companies, which is why we signed that big deal. The other thing also I want to say is that because of some of the uh, risks that investors uh, are perceiving, the valuation of office assets in India has corrected. So today there are very good value deals available in the office space. So that's the rationale for signing that big office deal. All the three assets which are falling within that deal are very, very well located. Those micro markets have very low vacancies. So they are strong markets, and we believe we'll get very good traction from tenants. Now coming to data centers, I mean, data centers, based on our, I would say, 4 or 5 year kind of an outlook, data centers should be at least about 15% of our portfolio. So the way we look at our portfolio will probably be about 75% IT parks, about 15% data centers, and about 10% industrial and logistics. So we do have a pretty proactive diversification strategy in place, not because we want to run away from office. We still think the office market in India is strong, but because we want to enter other asset classes also, which have got strong potential.
Okay, thanks, Mr. Sanjeev, for that answer. I think we have another question coming in. Given the huge the growth that we see in the Indian market right now, and also Jeff, the market strategist from SGX, sharing just now of the GDP that's increasing in India. So may we know how the competition among the REITs or the property sector there in India, and who are your main competitors over there?
So the Indian office market does have some very large players. Some of them are Indian companies, some of them are backed by foreign capital. So if I look at if I have to give you some big names that we compete with, we've got Blackstone, we've got Brookfield, we have got GIC, which is in partnership with DLF. We have got CPPIB, which has partnered with the Tata Group. So I mean, there are some very, very large, well-capitalized investors in India that we are competing with. But having said that, I mean, the market opportunity in India is pretty large. Every year, in India, about 50 to 60 million square feet of new office space gets leased every year. So it's a large market, and there is enough room for all the key players.
Okay. Thanks, Mr. Sanjeev. So were we, given that the recent AI craze that we have, or the tech kind of focus in the market that we are seeing right now, is CapitaLand India Trust targeting these tech companies in any particular kind of a segment to tap on the AI and the ChatGPT growth that's behind it, or even the chip companies to look at India's as a place to grow?
So it's playing out in two ways for our portfolio. One is that many of the new AI-driven applications, the software related to that is being developed in India. So it is benefiting the IT park leasing. The other part, which is very exciting, is that the AI data centers are much bigger. They need more data computing capacity. So it's actually driving up data center demand. So right now, if you look at the last about 6 months, all the three US hyperscalers are actively looking for space in India for expanding the data center business. So therefore, in both the asset classes where we have a presence, we see good benefit from this AI trend.
Okay, I think that's almost the time that we have for today. Any last thing that you want to add, Mr. Sanjeev?
No, I would just say that I think CLINT is a very unique vehicle which offers exposure to the India market through 3 high growth asset classes. I also want to say that I'm very proud to be a part of the CapitaLand group, which focuses on corporate governance in a very significant way. And that's reflected in many of our ESG metrics. So I would say that a growth market like India with a high corporate governance framework is what an investor should look forward to when they invest in CLINT.
Would you like to add what's the key risk that you are looking at for CapitaLand India Trust?
I mean, we always obviously have to deal with, I would say, one factor which is obviously playing out all over the world is geopolitics, which is beyond the control of any particular company. We have to always keep that in mind in how we run our business. The second thing, of course, which is around currency, but as I mentioned earlier, we have a pretty stable hedging policy in place, which helps to protect us to a certain extent.
Okay, Mr. Sanjeev, we'd like to thank you for your time and the insightful sharing that you have on the business. So I'll pass back the time now to Lucas. There's some closing slides for Lucas to present. Lucas, over to you.
A big thank you to all our panelists for their valuable insights. Thank you, Sanjeev. Thank you, Sunny, and thank you, Jeff. We hope you found this Corporate Connect session informative. If you have any additional questions, please do not hesitate to reach out to CapitaLand India Trust. If you missed any part of today's session, you can rewatch the webinar on SIAS YouTube channel. So Corporate Connect is our monthly webinar series, so be sure to visit us on our website for updates on upcoming investor education programs and initiatives. You can also let us know in the chat box any listed companies you'd like to see featured in future webinars. So for our next Corporate Connect session, we will actually be showcasing CapitaLand's sister company, CapitaLand China Trust, on the 26th of September. So once again, thank you for joining us this evening. Take care and have a good night.
Thank you. Thanks for giving us the opportunity. Thanks. Bye.
Thank you.